So, well, guys, now that you know what's the final result, well, you can also know that when you have in your companies, for sure, you will have multiple of cases of this, of forecasting and budgeting, things that are new for your companies in order to what? To do what? To expand, to look for new ideas, for new business lines. So how do you determine, now that you know that there is a risk and earnings, level of earnings and level of risk factor, that means that you need to have the optimum portfolio of investments in order to achieve the best results for the risk that you are having. The most common used example is, why would you invest in a company in Mexico that gives you a profitability of 4% when you can invest in what instrument do you think, guys, in Mexico? What gives you that level of profitability for a better amount of risk? Doesn't sound like CETES, which is Mexican bonds. The Mexican bonds give you 4%. What's the level of risk for Mexican bonds? They are considered free of risk. Considered. Obviously, they have risk. They do have risk. It's misinterpreted, but basically the risk is the country risk. In what would you invest? In the company that is offering you 4% or a bond? So now you're starting to get the risk price factor, risk price yield factor. So if you had multiple forecasts, guys, of all the business ideas that you have, you also need to assess the level of risk, because otherwise you could be potentially suggesting a project to your CEO or yourself as an entrepreneur, a project that could be potentially be misaligned with the level of risk that you're having. And that's why we want to achieve the net present value, and that's why we assess the level of risk of the components. That's the final part, which is the optimum portfolio of investment. The optimum portfolio of investment, it shows you from all your investment options that you are considering, the ones that you're considering, but because also we are limited to that, you are not able to consider, or at least nobody has achieved valuing everything on the markets. You are limited to your capabilities of analysis. Fundamental analysis brokers measure no more than 10 options, no more than 10 investment options, because you have to be an expert on the subject. But obviously you get to what are the best elements or components in what you will invest. Like, for example, in Bimbo, if they have on a yearly base 50 options of investment, they select based in earnings and risk these 5, and that's your optimum portfolio of investment. They have all their present value with the level of risk. That's how it's been done. This is the most common accepted criteria, because obviously it makes sense. Also, you value the companies for the amount of money that they provide to the investors with the cash flows. I'm showing you what we will achieve at the end. That is why we forecast. And let's do some scenario analysis. We will end up with the balance sheet. We will have to create the 2011 and 2012 balance sheet in order to create the cash flow. And the scenario analysis is that easy as moving this little guy in here, the net sales. What if we add a component in here from which what we can say that, what if this is 100%? I just put it and another variable. You can modify this as I'm doing it on your Excel. I just added this, and what if I put a 50%? What am I doing? Scenario analysis. So we can say that if we don't achieve 100% of what we are forecasting, we could potentially be in zero earnings. But that's not that correct. That's not that correct, because we are basing our expenses on a variable component, and that's not that correct, guys. I just wanted to show you how to forecast, but at an expenditure level, for sure, you will have to create well, for all the P&L, you will have to create assumptions in order to properly do a forecast. Because imagine that you will present or do a presentation to your CEO or to the board of shareholders. They won't question you regarding the P&L. They assume that you will do that. What they will question you are the assumptions that you create. Obviously, the first assumption that you are creating is sales. And for 2011, 2012, you will have to provide the assumption that you created. In this case, we created a linear regression with 90% confidence. And adjusted R. You can even put the linear regression, but in the level of expenses, you will have your rent, your monthly rent, your I don't know, office articles, no, office supplies, and that stuff is usually a fixed component, guys. It's not a variable component, so it means that it's not accurate to do this for a forecast at an expenditure level. If it's a variable component from the sales, it is a good forecast. If it's not, and it's a fixed expense, it won't be that correct. I just wanted to show you because this is what we didn't do, but you have to have that in mind. And you also need to have that in mind, that you need to create an assumptions sheet, because this is what you're gonna get questioned. And let's watch the result, guys, because as I told you, the expenses have a fixed component. So instead of doing it a variable component, removing this thing, we also can do this, so you can take a look of what I mean. Imagine if the level of expenses keep the same or have the same level as the previous year, which is not that common. What is common is that the prices increase due to inflation, and you have to increase salaries at least, no? The salaries increase at least in a inflation component. Otherwise, you are not, your employees are losing money or power of purchase power. If you earn $100 each year, with inflation, you are losing, right? So at least if general administrative expenses should be higher than, that's what you expect as an investor or when you're reading a forecast. It doesn't make that much sense when you get this, unless you tell me what will you save, in what things you are saving. Now we know that we have a variance or a decrease in sales at least an amount of 32%, we could potentially start having losses. So this could be potentially my minimum required scenario, no? This is what you can tell your CEO. Imagine, because obviously your CEO or your CCO, your commercial director, it's watching their sales on a daily basis. They are watching how it's moving, and they compare it to a budget and or to a forecast. So now he knows that if we achieve 68 of what we predicted, we're gonna start having earnings, or otherwise we could be potentially losing money. Now, do you get the importance of a scenario analysis? And it could be in both ways. What if we achieve more than we expected? Because at the end, you as an investor are trying to discover the next unicorn. Well, hopefully it's the next unicorn, but what you're trying to expect as an investor at least is to be in a good business, and to in a business that could potentially overgrow their expectations, because at the end it's gonna give you more value for your money. But what amount of value? Oh, if we earn 150% above what we expected, well, the earnings went up to 16%, almost double. Imagine if this is balanced out with the sector or the company. Well, that makes a very attractive result, or a very attractive or potential growth result for a company. Ready for a scenario analysis? Everything that you forecast or plan ahead should be supported with evidence. It has to be in your assumptions sheet. This is what you present, eh? When I present some budget, some forecast, some business case, what I would do is present the most material lines and show them what are the assumptions used on a very brief thing. Obviously, I'm not going to show a shareholder how to do a business valuation. But at the end, I want them to understand why I'm using to create a forecast. What am I using to create a forecast, and what it's based on, at least on the most significant lines. Like in here, for sure, I would question you, why would you expend this amount? And now you will have to have the detail, like, oh, okay, because I'm gonna invest 200,000 in Facebook ads, in Google, whatever. Okay, guys, that's the important message. Now you know what we're gonna achieve with the forecast, your fair value valuation. So next steps, guys, balance sheet. How would you think that we are gonna create a balance sheet forecast? What is your 2011 forecast? With what thing would you start?
But maybe using the ratios with linking them to the income statement.
Yes. What ratios? The cash is the final position that you want to get. I can help you with that. Don't start with the cash. Account receivable. Remember that we did something with account receivable. Remember that we have a formula in here which tells you the days of credit. So if we know that the level of sales of the income statement, it's gonna be this amount, and this is for the level of You can have it with the days in inventory and sorry, the you have account receivable turnovers. Like in here, the inventory turnovers, you also have a more direct criteria, but I'm explaining you how I do it. I think it's easier because if you know that this is for the whole year and you have 60 days that you already got in your assumptions. So if we apply this, so you have your daily income. Do you agree? Times 60 days of inventory. This will be the amount of account receivable, no? And also you have the same thing for your inventory, which is, wait, E4, this is E4, oh no, we need to use, yeah, the E5, which is the inventory is related to the COGS, remember that? So if the cost, if the COGS is per on a yearly basis, annual basis, you will have that. Oh, you also have 162 days of inventory. We can fix them to the sales instead of putting the. Always try to fix to the sales, guys, so we can track everything. So for the next year, the level of inventory will be 426. Maybe you can challenge that assumption as we are watching that from one year to the other, it doesn't move that much. So that's why you analyze past criteria and actual criteria. But for sure, this should be an accepted way to do it. Other assets, as you see, watch this line. It's not that material for what we're trying to achieve. You can just paste the average. That's what I would do. And that's it. For materials, for non-materials lines or non-material accounts, we can use the average. And for the fixed expenses, guys, there is a budget component. You budget your fixed assets investments. Okay, you have a budget that it's called CapEx, capital expenditure, because you need to do evaluation for the assets that you're trying to buy. You have to do evaluation for that. If you are investing in an asset, like it is an investment also. You have to do evaluation of that asset. Well, if the asset is just one car, maybe it's not that significant or material enough to create a capital expenditure for that. But what if like in the case of well, sentience, I don't know what's the sentience industry, but imagine for Viaja Click, I want to buy a fleet of transport fleet for customers. When they arrive to the airport, I want to transport them to the hotel, and I want to buy 20 vans. That would be a capex, a capital expenditure, and I would need to create a whole budget to justify why am I investing in 20 vans. Okay, let's do an average component in here. Don't worry about that. Ah, well, depreciation. For sure, you can, when you create the budget of the capex, you also create the budget for the depreciation, because at the end, you know what's your past or your fixed asset inventory by the end of the year, Actually, it's you need to do that according to the norms in order to properly evaluate your fixed asset components. At least you have to do one inventory a year. It's required by the norms. And if they do an audit procedure to your balance sheet, they will your auditors will review the assets, not all the assets. They will select some of them, and they are gonna watch them. They are gonna tell your team, let me see the asset. It's proof of existence. So if you can know the assets that you're gonna buy, then you can forecast the depreciation. This is now how it's done, but I'm explaining to you how you can do it. You don't do an average on the depreciation. You properly know your all asset list and run the depreciation for them. Let's do it as an average. Okay. And that's it. So we have our total assets. Why it's not that much or close to the previous year? Because we're missing one of the most important lines, but we can do an inference when we finished our forecasted budget. So short-term borrowings, for sure there's a fixed component. If you have a loan, you know what you will pay the next year. Agree? Not agree, guys?
Yes.
Okay, perfect. So also your taxes payable. What should be in the taxes payable line? What do you think, guys? On what basis we pay the taxes? Yearly, exactly. Actually, you pay them on a monthly basis, at least in Mexico. It's called provisional payment. But you send that to the asset because it is a prepayment of taxes. Then when you do the annual declaration, your annual estimate, then you put that line into taxes payable, because the authority gives you like 3 to 4 months to calculate and pay that tax. So you will know this line by the end of the year, but we can also apply an average. No worries about that. Oh, and more than an average, I would use the income statement. Remember that is a line, a provision of income taxes. That is a line in here. So let's do the 100% line. We can use this one, no?